the big theme for markets is stimulus. That's the big thing. That's what's driving. Basically, there's the QE is and balance sheet expansion has risen at the highest rate ever. It continues to keep going. The Fed says it's going to keep going at about this rate for the entire year at least, and they've kind of winked at the fiscal authorities and said we're going to fund this. So you don't really need to crowd out businesses or anything. And so that's a ton of liquidity that's sloshing around, and a lot of it, so it goes into bonds, it goes into stocks, it artificially lowers interest rates, all those things that push up demand for stocks, almost regardless of the backdrop, regardless of valuations or any of those things. So just realize that is continuing to happen, and it's sort of the big underlying fundamental here. Where coronavirus infections are rising to new highs, but we've got a vaccine and we've got the potential of a normal recovery with the vaccines in the second half. So really markets and investors are kind of looking over the valley of this coronavirus winter to a more normal recovery. And we've got more fiscal stimulus coming. So we look for loaded growth being primed for late spring or summer. So things are started off with a disappointing start to the vaccinations. They had a few hiccups, but now the numbers are starting to rapidly improve. We're up to 6 million people that by this weekend that got vaccinations in the United States. The Fed is basically saying it's going to do everything in its power to support domestic economy. And Biden has now tacitly announced or leaked through Axios its plans, and the plans are very stimulus positive. So they're talking about really immediately another $1 trillion stimulus package in the first few days. Or week or so after Biden is inaugurated. He's got basically, he has the Congress, he has the Senate with the VP, and so there's very much, it's not likely to stop it. And of course, it's going to be hard for most moderate Republicans to vote against something seen as important to the health of the economy. So additional 1,400. So we just supposedly have $600 checks in the mail. We're going to get an additional 1,400 pretty quickly, and there will be in that $1 trillion package aid to state and local governments, vaccine distribution funding, and extension of unemployment benefits. And then Biden's talking about a second green infrastructure package of $2 trillion going into roads, energy grids, schools, universal broadband, etc. So the two will total more than $3 trillion, which essentially doubles down on Trump's two major coronavirus aid packages in 2020. So we're not only have we had more fiscal stimulus already than we had after the entire GFC, we're going to get another round that's basically doubling up on it. And with the Democrats having 50 seats and basically effective control of both houses of Congress, there's not going to be much that can be filibustered, and it's going to make it easy for particularly bills that are not controversial to be passed very quickly. So markets are betting on more stimulus immediately. They're already betting on it, and more quickly thereafter. And infrastructure stocks are part of the sort of rotational leadership, suggesting that markets are discounting infrastructure spending the first in Q1 or so. Now, there's a lot of pent-up demand and COVID fatigue. It's likely to lead to a resurgence of demand once vaccines proliferate. More broadly, we get to a more normal recovery type environment, and maybe even a little earlier than that. But certainly when we get to the post-coronavirus world. And so investors and consumers are sort of looking over the valley of this winter, even though it's got more cases than ever, and they're looking to the other side. And with the amount of stimulus that we're getting, it's going to be sloshing into markets. Absent some kind of real shock, markets are likely to be forward-looking toward the recovery, at least until we start to get negative unintended side effects and stimulus hangovers that develop probably 2022, 2023, but certainly not until late 2021. One negative development that you want to keep an eye on is that the Democrats already seem to be in a full-scale purge of prominent conservatives, of anybody who supported Trump. They're talking about impeaching Trump after he leaves office so he can never run again. He's been kicked off of social media. The social media and the main media are really now very one-sided. They're sort of Pravda-like if you don't buy into their viewpoint, and that's really, yeah, they're talking about firing conservatives from jobs and just canceling in every way everything that Trump has done, and that's kind of a scorched earth approach from the political winners, and there are legitimate questions and concerns about voter fraud. We had, like 13 states that filed suit against those 4 states that had real questions about voter fraud. That really was never addressed. And I think that's a mistake if that's really the way it's going to happen, where these questions go completely unanswered and ignored and blacked out of the media. We kind of had the blackout of the fact that Biden's son has made tens of millions of dollars essentially working for the hedge fund that manages for the main Chinese political parties. Those kind of things, if you blackball people out of that people are going to think that you don't have free speech, and the polarization is just going to get uglier and uglier. So far, it looks like we're in for very bitter, tense political ongoing battles that's just going to divide society even more, particularly if this kind of behavior continues. At least for the recovery side and for markets, though, this is a good example. PAVE is an infrastructure play that was ETF that was sort of on our ETF list last month, and you can see that the outperformance has been substantial. Breakouts in relative strength, breakouts in bases, breaks out in multi-year braces, and good runs, and that just tells you that the markets are really discounting major infrastructure spending coming. We can see that the money flows are still quite positive into the market, which is unsurprising given the degree of stimulus. They're not making new highs in terms of amount, but they're still very, very positive. And then even in looking at the internals, almost all of the internals, the major internals are making new highs here. So we don't even have the kind of divergences that usually build for multiple weeks or multiple months before you get an intermediate term correction. So there's still potential upside to come. People are talking about earnings projections, and they're looking at changes in behavior and pent-up demand, et cetera. And so it's possible that earnings could rise much faster than expected to continue to fuel a bull run, later this year. So you probably, usually after this much stimulus, you've got a year or two at least of a run, and that's looking like that's possible. Beyond that, we really have to watch how quickly unintended consequences and other problems develop. Now, short term, we're way overdone, and it's kind of a raise your trailing stops and just sit there type environment, really, to a large extent. But we can see that the Russell's starting to get up to some theoretical resistance levels. So if we get consolidation or correction, could happen anytime. And then more and more people are watching this sort of analog with the 2009 recovery, which was so infrastructure or not infrastructure, but stimulus led. And so you can see that actually those two correlate much better than this blue line, which is a correlation of all other recoveries. So you really are probably looking at the July 1932 lows, or the March 2009 lows, those analogs so far for the behavior of stocks. And you can see that stocks continued up then till April before we got a significant correction. So we could still have a ways to go. Anytime you could certainly get a short-term correction, and it probably would be welcome. I'd like to get consolidation or correction to build up some bases and some new potential plays. But until we get that, it's just raise your trailing stops and smile. And you can see that the new list of both ETFs and stocks is quite similar to last month's. We're getting more the rising of some of these cyclical. So remember when we first looked at COPX a couple months ago before it really exploded, it really didn't make our list properly. It was just sort of showing really good short-term relative strength in the last quarter. And of course we saw, the copper breaking out, and so we had some good idea that that was likely to be a real recovery play. But now it's jumped into our top 10, and so we're getting our lists are sort of expanding and increasing and showing more things that are more cyclical plays. More, so we've got industrial recovery, got rare earths. And you've, of course, clean energy, which has been exploding, and it's certainly overdue a correction. And then some of the ones that have been, the drivers before, steels, for example, are not, but steels are more of a recovery play. But, the online retail, some of the electric vehicles, those are getting overdone, and you're getting sort of a switch. Some of the consistent ones like semiconductors still really there's good potential for them, and they also led. So those are ones that could be sort of consistent leaders. But really, the list is not changing a lot. You got South Korea, you got Taiwan, you've got retail and the cyclical consumer cyclicals. You got robotics, which is and sort of industrial innovation type ones that are kind of where, if we do get capital investment, it's likely to go, and they're both tech and new recovery. And you've got some of the older themes like the gaming and stuff, because people are still locked up. Banks are coming up a bit. We don't really like them, on a long-term basis, but as we'll see, we're getting yield curve and interest rate moves that are positive for banks. And then, of course, we've talked about emerging markets, that 13-year base breakout that's likely to lead to substantial moves. And of course, we've been highlighting marijuana as a growth play, and it's starting to creep onto the list as well. So it's not a lot of different groups. It's mostly raising trailing stops and waiting for sort of the next consolidation or correction, which could happen anytime. But still, looking at the internals, you're probably looking at a volatile grind until we get more divergences developing to build to a correction. The emerging markets, of course, we've talked about. They've broken out of a 13-year base. Now we see the breakout in the relative strength from a multi-year base as well. Those are types of things that usually lead to multi-year moves in terms of relative strength and leadership. And with a weaker dollar, this is likely to be good. I still think there's probably going to be a little bit more volatility with these than you got with the S&P, and then U.S. markets have displayed, because you have things like higher interest rates being a problem. You've got the dollar really being critical. And so if we bounce off of 88 support for a while, that could kind of undermine these a little bit. And then also a lot of the emerging markets are in areas where over the next few months the weather gets colder, so they could be facing a wave of further coronavirus spread that we're kind of getting over in the West, or starting to. So there's a few reasons why I think you may have an opportunity to add more and get some kind of correction, or at least consolidation in the emerging markets. But really, on an intermediate term and long-term basis, you want to be switching into that area more and more.